Preparing to live stream. The meeting is being live streamed. Okay. Welcome in, everybody. This is the Chit Chat Money Investing Power Hour number 22. So we've been doing this for 22 weeks now, huh? The
All
or yeah, go ahead.
I was gonna say almost half a year. We got, consistent listeners over on the podcast. However, we do this on YouTube as well. So anyone we don't care when you listen to it, but if you want to watch it earlier, you can watch it on YouTube with about the 10 other people that do so. But either way is fine with us. It's fun. It's fun to interact and you can get some questions in, which we'll hopefully get today from the live chat.
Yeah, I mean, we do record it in the middle of the workday, so
That's right. Yeah, we should
probably
probably
tough for
go.
some people.
Yeah, it might be better to go after the market closes, but you know, yeah.
Anyway, this show we talk for an hour, riff on anything financial markets. Don't really come prepared with anything, although I've got some stuff in the back of my mind for this week. And yeah, it's live on YouTube at 3 o'clock Eastern time on Thursdays. So we are currently at that time. Do you have anything that piqued your interest this week? I gotta say, I listened to that Joe Rogan interview with Mark Zuckerberg, and I thought it was a phenomenal podcast.
Yeah, but I get did it get you bullish or bearish on Meta? I mean it's interesting, it was interesting for sure. The guy's got, he's dedicated, you know, but dedicated to what? Is it, you know what I mean?
Yeah, I mean, it didn't really. I don't know if it changed my outlook on the investment of that is Meta, but I'm definitely more bullish Mark Zuckerberg. Like that interview made me think more highly of Mark than I did before, and I think part of that I got to give credit to Joe Rogan because I've listened to other interviews that Zuckerberg was a part of, and he was giving sort of robotic answers. You didn't really get that much out of him. This really, like, I felt like you really got an authentic Mark Zuckerberg, which I think he is way more pragmatic and like nuanced, like a Daniel Ek type than the way he's sometimes presented in the media.
Yeah, there's definitely a narrative around what he is. It's hard to get a grasp. Yeah, I mean the questions are way better than so many other interviews. Most of the time they're absolutely awful because they don't push. And then he definitely pushed him that time, which is probably why that show's so popular. But yeah, I mean, interesting interview.
I
Three
loved,
hours. Super long.
yeah, I did love how deep they went into like Facebook's not only recommendation algorithm but also like decision making like systems around choosing how to moderate content, like how complicated the actual decisions are. And then like at one point they were like, all right, well, how do you decide what, like basically they went down this like what is misinformation rabbit hole. And then at the end, like after Zuckerberg explained how Facebook goes about it, he's like, what would you do? And Rogan was like stumped. He's like, yeah, I have no idea.
It's pretty
It's
it's
an
pretty hard.
impossible problem.
Yeah, it's pretty darn hard. And I was listening to another who is it? Like I think it's The Verge has a podcast about the history of Facebook, and then now they're getting to the last episode and it's about the metaverse investments, and they were talking about the Horizon Worlds or whatever their new social network is supposed to be with the Oculus. I forget what exactly it's on, but apparently it has 300,000 people, something like that. And these reporters went on there, and what was so funny is the exact same issues. Well, maybe not funny, but ironic was the exact same issues that were on all the other social networks are happening on Horizon Worlds, where you have young people, you have people being vulgar, racist, all that stuff that it's pretty uncontained. and they're like, huh, this is,
Maybe
I
this is
guess the
just the
same.
world.
I guess, yeah, this is the same problems that we've been having, just because we have these weird avatars doesn't change much. But yeah, I guess besides that, bear market's back. Bear
Yeah,
market is back.
gotta love the bear market. Um,
It's very back. Although I guess we've had quite a bit of recovery today. It was
I,
really back this morning.
I've been doing some just like wrapping up all the earnings that I didn't get to during the heart of the season. Few interesting ones. Best Buy in a very precarious position. I would hate to be them.
Really? Why so?
Well, they had, I would say, and management would probably say, elevated demand last year. Both with apparently like everyone took their stimmies and bought new TVs. And so they're kind of lapping that, and they're seeing, I think it was minus 12% comps this quarter. And inventory shot up, which I can't think of, like, other than perishable food items, I can't think of a quicker depreciating inventory base than, like, because well, maybe not everything, but like electronics are evolving so quick. Like they're making new iterations of so many different technologies that like old equipment depreciates fast, I imagine.
Yeah, big potential for write downs for sure.
So I don't know. They just seem to be in a tough spot. And then I was thinking, like, all right, well, what is it relative to expectations? It was a little better than what management guided for. And it's like, okay, but there's so much fish in the sea. Do you really want to have to bet on Best Buy when, like, it's still a difficult business?
Yeah, for sure. That I mean, you see that, I guess, Bed Bath and Beyond's a meme stock. Yeah, all these old retailers. It feels difficult. I don't know if the retail footprint's the problem with Best Buy, but that seems to be the problem with almost all of them, is that their retail footprint is too large. They would in a hybrid, in an omni-channel world, you'd probably want, and with malls less popular, you probably want a smaller store footprint where people can like shop online, and then, the store can be useful, but it's not these giant, almost warehouse like things. That's probably not useful unless you're a Costco. So that's just a giant disadvantage compared to companies that just don't have that, because they have those operating lease liabilities that are huge. I think that's not a very articulate way to put it, but
Ironically, on the flip side, I thought Chewy also had a pretty poor quarter, who is kind of like the inverse of what you get with the Best Buy, where it's supposed to be solely online strategy. Not a great quarter for them either.
really, what was it? Slow revenue growth or what?
Revenue growth is fine, thanks to pretty much increasing prices by a pretty sizable amount. But the number of people buying like discretionary items, so like like food, let's say like treats and toys, like that saw some demand compression. And then on top of it, I just struggle to see how they can generate any consistent profitability.
Yeah, low margins, right? If I remember correctly, I haven't looked at them in a while, in a couple of quarters, but it seemed like the margins were so low where I just went, why? This is just a tough game to play. And yeah, I mean, we've discussed Chewy before. I forget whether if it was on here. I think it was probably with our discussion with Paul Sarro on the episode where we did, he was pitching long Petco, short Chewy. So I think that was when we discussed it. So we're interested more in the details of that business and why it might be structurally disadvantaged, even though there's that e-commerce tailwind. I would listen to that. But yeah, it just seems like a tough one to just a tough business to run. And
It's not super cheap either.
Yeah, when headwinds materialize, stuff like that, and basically whether we're in a recession or not, there's headwinds that are kind of materializing right now is maybe the best way to put it. It might be foreign exchange, it might be input costs. You realize what businesses are actually really good and can kind of determine their own fate, or what ones are really determined by, macro, whatever, all that
Yeah, I
stuff.
guess every business just ends up being a cyclical. I would have thought like a lot of the companies we own, it's like, oh, it's not going to be a cyclical, but
Yeah, I mean, you can't expect revenue, like, you can't just expect revenue growth to go up for every company at, I guess it kind of shows to me the way that modeling financials is sort of useless. Like, okay, they're going to grow revenue at 15% for 3 years, and then whatever 10% for 2 years, and then they'll have this terminal growth rate. You have, it's never going to be like that. It's going to be
yeah.
bumpy. Almost every company, except in the rare circumstances, it's gonna be lumpy. There's just
And
gonna be.
yeah, it's given me more respect. Like the last 2 years have given me, what's that quote? Respect the cycle. I think there it's given me so much more respect for the impact that interest rates actually have on really everything, even if you think your company's insulated from it. And I think I have more respect now for the wealth effect on consumption habits. Like,
That's fair. Yeah, I think that makes sense. It's hard to quantify what the wealth effect does, but I mean, why don't you describe maybe some people don't know what that theory is, but
all right, and maybe I'm getting it wrong, but let's say you're in a bull market, your investments continue to go up, your wealth on paper continues to rise, your capacity to spend starts to increase because you feel richer. And when that contracts, those spending habits also contract, despite that never being actual material wealth. It's just like the mental effect of being richer or being poorer changes consumption habits. I think we're seeing that with a lot. We're kind of seeing that on the top line with a lot of companies that I would have thought, in particular in the retail space, wouldn't have been super susceptible to it. But I guess, yeah, I kind of got to respect the cycle, I guess.
yeah.
Oh, for the listeners, last time we spoke, I said I'd be going to New York. I went.
Oh yeah, let's get an update. What are we thinking? How was it?
I didn't get a gauge on it. Didn't change my sentiment on the market, unfortunately. However, and I know this is going to trigger some people because I know I can see the data. I know that we have New York listeners. A decent chunk of our listeners are in New York.
The greatest city, as well, what do they call it? I don't know. There's all those terms.
The city that never sleeps.
Yeah, whatever. The city
City so
never
nice. City so nice. They named it twice.
Exactly.
Uh, I think there are some benefits as an investor to not being in that city.
Talk your book. There we go.
And I in my head, I thought, well, like, yeah, it'd be cool to be surrounded with that many, other investors. And I'm sure there are benefits, but you get, I think, a better, I don't know. I think you can think slower sometimes and like actually kind of digest your thoughts a little more in a way that like helps with investing and not being rash with decision making. Like
Yeah.
I think Chanos has probably talked. I think it was Chanos that talked about it. Where like maybe I'm wrong, but like you go into the office every day. It's this fast paced environment. You feel like today's the day that you got to make something happen. There has to be some big investment decision. When in reality, there's very few times when you should be making decisions. I think New York just doesn't help with that because it's such a fast paced environment.
Yeah. Here's a weird question. How is the noise? Is it loud all the time, like people say?
Yeah.
That's
Yeah.
just
For
got to
like,
be tough to focus, right? You know?
for the first like day, like in Seattle, if I hear a honk, like from a car, I think like, oh, they
Yeah,
might be honking at me. Like,
yeah, what's going on?
yeah. So I like turn my head. And so for like that first day, cars kept honking because it's like, yeah, it's like they're speaking a language there. They're like, oh, hey, I'm here with like two honks or whatever. And I kept turning, like looking around, like, what are they honking at? I, eventually you just learn to tune it out and everything just becomes sort of blank noise. But it, yeah, it is very loud.
That's got to be tough. Um, yeah, I don't know. He's got good food though, right?
It
How's
did have some good restaurants. I will give them that. I
weather's
went.
gotta weather's gotta be so awful though. Just awful.
The air didn't feel very fresh,
Well, no, what?
but I mean it was like decently warm. Felt pretty humid though, which I'm just not used to from out here on the West Coast. Um, I didn't think the weather was too bad, especially if you have like a place with AC. But I don't know. I think it's the humidity and like the coming from Washington. If I feel like if I was there for long enough, I probably wouldn't notice the air quality, but like the air quality was frustrating for me.
Yeah, and combined with like there's a lot of concrete. The funniest thing I see on like financial Twitter is when someone posts like a picture of like a tiny park in New York City, and there's like 1,000 people there, and they're like, "Look at this, it's awesome," and I'm like, that looks like hell." You know what I mean? They're like
I
summer,
know I know
summer.
we've probably lost all our New York listeners in this episode, but the
Yeah, we'll transition new topic soon unless you have some final
I
thing.
do like, don't get me wrong, the city's pretty cool. I think it's also just like a marvel of human engineering because the amount they've been able to fit into one area is pretty crazy. Um, and there's like there's always something to do, which is cool. But I think for an investor, there's benefits to not doing something all the time. So
Yeah,
I don't
you
know.
got a point. I think you got a point. We had a
I just felt distracted a little bit, but still a cool city, and I think certainly worth visiting.
Yeah, we got a question here. I don't think we'll be able to answer this one. Sorry for whoever asked. If you're still watching, it's what are the top 5 companies to invest in right now for the long term? Are you writing a Motley Fool article for me? Sorry, that's a joke. But uh
That does sound like a
that's
Motley Fool title.
that is a Motley Fool title. That is a question that's going to be different for everyone. So I don't think we can answer that. Sorry to whoever asked, but you
All
know,
right, let's
it's a personal question. Like for
let's spin
different.
it. Let's
Okay.
spin the question. What five? Let's maybe do it less. What three companies would you be comfortable just holding on to for the rest of your life?
Okay. So say we're young, say like 75 years, something like that. If we're going to
Yeah,
be optimistic.
something that's in that Roth that no matter what happens, you're probably just not going to touch it.
That's a hard question. We did the 275 years last week, which is almost impossible. I think I would go. I want to say like the Berkshire Hathaway or the Nelnet, which you know we own as a baby Berkshire Hathaway, but the management transitions worry me there. So I think I might go something more consumer goods. I would avoid alcohol because I think there's a bit of a risk there over the long term that people transition more to cannabis and other stuff. And you've seen that trend the last decade or so. So I think I might,
Seltzers have also been a little disruptive to the old
yeah,
alcohol
there's
industry.
more disruption in alcohol for CPG. So I think I might go with this. Hershey as my number one choice. Extremely durable. And it's not just Hershey, they have Reese's and other candies I'm forgetting. I might go Man, it's really hard. The other ones here. 75 years.
Any cigarette companies, tobacco companies.
I think no, can't do
Think
that.
cigarettes will be obsolete in let's say 25 years. You think cigarettes are obsolete?
That's a tough question. I think in the United States, yes. If I had to bet, I would say yes. In the
I
United
will
States. In the
say
United States. International, it's a lot more popular.
they felt a little more common on the East Coast, or at least in my time in the city, felt
Well, it's so
much more
hectic.
common than Seattle.
Yeah, we're less stressed out here. I've been looking at my background. Imagine smoking a cigarette out there.
I think it's also just different
Different culture
or different vices.
okay,
Like
I
I
got
think
one.
Seattle's maybe more vape cultured, if you know what I mean.
Yeah, vape culture, cannabis culture. One, Hershey. Two, now this could easily blow. This one could blow up in my face, but no one's gonna know because it's 75 years. I think I might go Costco.
I like that.
Three, Pepsi. Just because I might go Coke, but I like Pepsi more because of the diversification into snacks.
Okay.
What about you? What's your three?
I'm gonna go JP Morgan.
Hey, 200. That's 200 years old, maybe about.
I don't know. Was it not was John Pierpont Morgan not the one that actually did he buy an existing bank or did he start it? Because if he started it, it would have been like what, 19 or 1880s?
No, his dad was the original Morgan, I believe. So he was actually a little bit of nepotism, but it was like nepotism and the JP Morgan we all know. That's the most famous, kind of took like the company to a whole new level. And there was they were in England for a bit too. But again, I think it's actually older than that. I think it origination back to the early 1800s, which might not be a bad pick. You could see them lasting 75 more years for sure.
Yeah. So all right, JP Morgan. I'll take you up on the Hershey's. And I think I'm gonna go Home Depot.
Interesting. Yeah.
Maybe McCormick.
Ooh, McCormick's a good one too. Spices are simple. Spices have no vices. That I didn't mean to rhyme that, but you know what I mean. Like spices, right?
We got some more questions in here.
Yeah, I like those. I like those choices too. McCormick is a great choice. All right, yeah, good. There's good questions. You wanna go through them? First one.
We'll take Wix. So Sandeep asks, considering they have a SaaS-like model, why is Wix the opposite of a cash cow, low growth and 10% negative GAAP margins? Well, I think cash generation is not GAAP profitability is not actually indicative of cash generation. So it's but nevertheless, the cash flow margins have been hurt as of late. The I would say there was technically three drivers in that, and a lot of that was just increased development costs and inflated customer support costs, sort of tailing off of COVID, which I think they've bared the grunt of that. And a lot of that is front end, like all the costs kind of come in the front end. So, or the majority of them do. And I think they're probably going to start to see and reap the benefits now of the products they've kind of developed. The main one being the partner oriented product, which it's what Editor X is considered, or is it?
Yeah, that would be Editor X. I mean, there's other stuff too with the e-commerce build out and the Wix payments build out. There's a lot of product development that went into those. And if actually, I think the best chart to look at is, I guess everyone might not have access to Y charts, but you can probably look at some free resource. Their free cash flow steadily went up until early 2020. And then COVID hit and they actually got a huge acceleration in growth. They had to invest for that. And on top of that, they had to invest, they were already investing into the e-commerce stuff to compete with Shopify, the payment stuff, which goes along with the e-commerce to compete with Shopify, and the expansion into Editor X, like Ryan mentioned, to embrace the partners and try to steal people over from WordPress, which they've been succeeding on. However, cash flow doesn't look great right now. You got to trust management, I guess.
Well,
Like
I
we
would say,
mentioned,
he's essentially asking about the core business here, basically being a
Oh,
software
right.
business. And I
Yeah,
think you're
yeah.
right. So it is essentially a software business. And there was a point in time, I think, I want to say like right as they were hitting 2020, free cash flow margins were 18, 19%. Management thinks they can get back up to 20. I think they're right.
They're claiming that the core business that Sandeep is referencing here still has it right now. It's just masked by other stuff.
Yeah. So I guess I hope that answers the question. As for the growth side of it, new website creations generally have slowed this year, which they are, even though I think they will each share of new websites that are created. If the actual growth of the category as a whole is slow, they're gonna see that. So that's been sort of a big hindrance for them. And then also respect the cycle. I mean, they're not immune to it either. So
Yep. I mean, their growth was really, really great last year. For investors like us who may have bought at or did buy at what looks now like a high price, and it was probably a mistake then. The comps are tough this year.
And they're levered more to the consumer now because of the GPV element of the business. So it's similar to, you've seen how Shopify's revenues come down. They are now, because they have, I want to say it's $10 billion in annual payment volume on their platform. They're going to, once there's like if there's a broad recession, their take rate of GPV might be flat, but the actual GPV might be down because consumers just spend less on Wix-based platforms. So there is that as well, which wasn't really a part of the business prior to, I'd say, 2019, 2020.
Yeah, a lot of moving parts there, and you can see why people are down on the business. But if you trust management, they think that things will look a lot rosier by 2025. I'd watch their investor day. I know it's long, but to get an overview, it gives you a great overview of what they are thinking. Next question.
We got a few more questions. Why don't you take next question?
Okay, this one should be easy to solve. How do you think the new college forgiveness affects Nelnet? One, it should be small because it's only $10,000. However, if you're interested in Nelnet and worried about the college forgiveness stuff, and we don't need to go into the complications of how Nelnet works, but basically they own a big loan book of student loans, and they get paid back on that. And if people pay back their loans earlier, they're going to get a little bit less cash. In their 10Q, they outline different scenarios at the end of the 10Q about what sort of cash they'll get and when, depending on how fast people pay back their loans. I'd take that. I'd check that out. I don't have it in front of me, but they would get less money, and every incremental dollar that gets paid back earlier, they will get less money. However, the upside is they'd get more earlier. Instead of say in 2025, they'd get more in this year and the next year. So I don't think it's a huge downside for them, and they're actually transitioning away from this being a bigger part of their business. But yeah, it's something to watch out for the company, and maybe even more on their servicing business, but we don't need to get into a whole Nelnet discussion here. Hopefully that answered it. All right, next one. You want to take the next one?
Yeah, Ross Van Kohler, I think. He says, if you weren't allowed to invest in any developed nation, where would you invest? Ignore currency risk. You were not allowed to say Korea either.
Japan.
I don't quite understand. Saying like, if I could invest anywhere.
You can't go in North America. I'm guessing this means you can't go in North America. You can't go in Europe. And you can't go in, I'm guessing, Japan and Korea. I will go Mexico because it's the one I think I can understand the best. just because there's some sort of relation to Southwestern United States. I mean, it's not perfect, but if I'm going to get consumer anecdotal evidence, which is important for us, I would go Mexico.
Mexico's probably up there for me as well. I think there's a lot of Scandinavian countries that have similar consumption habits to Americans.
No, developed. That's developed.
Scandinavia, we're gonna. God,
Let's develop.
right.
Come on.
So
Look at
emerging,
the.
basically, which emerging market would you invest in?
Oh yeah, yeah.
Well,
Scandinavia is the
Mexico's
most developed.
closest. The
Got a comment here that said India. India is so interesting, but I don't know anything.
yeah, I don't even know what if there's really the. I don't know what the income levels look like on a per capita basis, so it's kind of hard for me to understand the potential customer bases for different companies there, but obviously there is a huge opportunity just in terms of sheer human beings in that country. I think that's
Yeah,
why
let me look at their India GDP per capita.
big tech always comes after.
Yeah, I mean it's only $2,000 USD GDP per capita. I mean, if that gets to $5,000, given their total population, I mean that would just be, huge.
Yeah, just
We don't need to run that math.
very different infrastructure as well. So I don't know what e-commerce looks like. That's a tough one.
Yeah, I like
Maybe,
I like Mexico a lot better than India just because the United States kind of helps them out a bit. Even if they have like weird relationships where the leaders kind of bicker at each other, in their heart of hearts, they know that they need to work with each other. We got a Saudi Aramco here. Yes. Not bad. Not a bad answer either. Not a bad answer either.
All right, here's sort of maybe an ethical question for you. Let's say there was deep value in some Russian organizations, stocks. Is that something you'd be willing to make money on?
Is that something I could be interested in? No. It's not
Where you draw your
moral.
line?
No, not morally. It's just I don't know if
Like,
I'm gonna get the money back.
What if the securities get removed?
Yeah, it's similar to China where I worry about political.
But at some price, isn't it still technically worth the risk?
Yeah, but there was a good joke from someone one time where they said, I ran a DCF on all the cash I'm going to get back from Alibaba. And then it was just a table of zeros from now until 2025 or sorry, 2050. So no matter how cheap something is, if there's the risk that I just won't take that risk.
All right.
I mean, it could literally right? Like if Alibaba, no matter how cheap Alibaba gets,
if you've got, but if you're okay, let's say you may never get the dollar back, but I like $1 back in cash. But if you get to the point where the market is going to assess it some valuation, that's just like the reality, even if you're not getting any cash back for the next 30 years. If it's generating $100 billion in revenue and generating $30 billion in cash every year, and it's got a market cap of $20 billion, I think that is worth the risk, even though you won't get the cash.
I don't know. They pay a lot. They might. If it's trading at that level, it means that the political stuff is out of control. I mean, the fines they've had to pay for being too profitable is just insanely concerning. And at that point, you are still betting on another person paying a higher price for it, which is, riskier.
Okay, let's say you buy all of the shares outstanding of Gazprom for $10.
Yeah, of course, but that's not going to happen. I mean, let's get realistic.
I got a feeling if any of those securities get relisted, there are going to be some,
Oh, there
deals
could
on the
be some
table.
there could be some deals on the table. I don't know if Gazprom will go for $10 though.
It's fair.
Maybe if you were a large entity, it would be worth it. But then on the flip side, if you're a large entity, you might get political pressure to divest, if you know what I mean. Who had that stake in Gazprom that they had to just get rid of? Was it BP? Something like that. I don't follow that market too well, but they had like a 20% stake in Gazprom, and they kind of just got pressured to say, "Oh yeah, we're just gonna write that off. Yeah, we're fine with that." And they were probably, smiles on their face, and behind the closed doors, they're like, "Oh my God, Putin, come on, man, make
All right,
us."
let's I got a new question here. We just did an interview with Simon Erickson on QuantumScape, which is basically solid state battery technology, kind of early innings, no revenue, but the opportunity is obviously large if things go right for them and they're able to execute on the actual technology of it. Would you ever invest in a company that has zero revenue?
Ooh, good question.
I know we're probably a little more risk averse than most investors. So
I would say,
have you ever?
have I
Like
ever?
at any point?
Ooh, have I? I don't think so. I don't think so. I've invested in some bad companies.
What was that? The first stock you bought was what?
There was
You
a penny.
US
There was a.
Steel because the
Oh yeah. I did the old. It was Infrastructure Week in 2017, and I was starting. I had no idea what I was doing. I was like stocks to buy or whatever. Some article came up, and it was, here's some stocks to buy that will do well during Infrastructure Week. So I bought. I had no idea what I was doing. That was like 6 years ago, something like that.
I'm
So
pretty sure the first stock I ever bought was
no, you were a Netflix guy at the beginning, right? I remember that.
I don't think it was my first stock. I think the first stock I bought was on Robinhood. Netflix I owned
Oh,
on like
Chesapeake
Schwab.
Energy. They got you on that Chesapeake
Well,
Energy grind.
I'm sure I was granted some shares. And you know what? I bet if I would have held that, it'd be all right. I wonder what it trades at today.
Chesapeake Energy, CHK. Let's guess. I mean, they were giving it away for like $3. Wait, no, never mind. Must have been a
Because it's
stock
natural
split.
gas. I'm pretty sure I thought they were giving it away for like $3, but there's no
No,
way.
they must have recapitalized because it's at $100 a share now. And it's no way it was that low of a market cap before then. It shows trading back to 2021, so maybe it was recapitalized. But back to the question, pre-revenue, I would, yes, but it just depends. I'm not really a big, like, usually if something's pre-revenue, it's either pharmaceuticals. That's just a no-go for me. And then it's also either something like QuantumScape, which is based on really, really advanced technology, innovative, whatever areas. And I don't like that either. So if there was a pre-revenue company in the niches we like to invest in, maybe. But those never really materialize. So maybe if there was a pre-revenue game studio, right?
Yeah.
That,
It
like there
just
was
hasn't
a,
thrown out a monetization strategy yet.
yeah, and they had the head of a studio that we trusted that worked somewhere that we really trusted. Yeah, but like something like QuantumScape, that's just not where I like to invest. Doesn't mean QuantumScape's going to be a bad or good investment here, or doesn't mean that those type of investments won't work because they're almost, we talked about in the interviews, almost like pharmaceuticals. Yeah,
We've got some interesting comments here. Yeah. The
QuantumScape 50 billion market cap. Yeah, I mean that was
I didn't know
that
they'd gotten to that point. That's what's the most insane valuation you've ever seen on a stock?
well, I think we can sum it up to 3. QuantumScape, when it was like at 70 billion, I think, or maybe it didn't get hit 70 billion. And that was basically Simon was saying now when it has a market cap of like 4.5 billion, he was like, look, we could probably hit a market cap of 50 to 100 billion if things go right by 2030. And that was already happening. Like, and that's, it's risky. It might not happen. And that was already getting priced in back in 2021. Second, Rivian pre-revenue. I mean, that was over 100 billion. And then third,
I mean, Nikola.
Nick. Okay, well, let's toss in four then. Nikola, yes, yes. I mean, these are all EV companies. And then fourth, Tesla, over $1 trillion. That
What about Tilray in like, what was it, 2018?
2018. That was a good one too. 420 price to sales. I remember hitting that. I remember hitting that. Yeah. Yeah, that was tough.
I don't.
Down 77%.
Those were, you know what? Now that I think about it, I mean, obviously we knew it even kind of during, like, I think it was blatantly obvious, but those were probably, we're going to look back on we'll probably look back and see those as some of the most overvalued stocks of all time.
Which ones? The cannabis or the electric vehicles?
Well, electric vehicles.
Yeah, more dollars. They're just way bigger. The cannabis bubble was nice and fun and insulated. Really small.
Yeah, that was niche, but
yeah, for sure. Those.
And you know what's funny? When we were saying, like, I said, like, this feels, a bunch of people said this, but there's some parallels to the .com bubble. People said, well, those were companies getting insane valuations with no revenue. That's different. It wasn't different. We're experiencing the exact same thing.
Yeah. What's funny, yeah, it was well, I mean, you could argue it was a tech bubble-ish before we got the SPAC craze with people, with companies that were generating revenue. There were some strong arguments that companies like DoorDash, Uber, I guess WeWork didn't really go public, but there was, you could argue there were some good arguments out there that there was a lot of startups that were going public with unsustainable business models, but a lot of revenue. But then we just kicked it into overdrive and said, screw it, let's just create .com 2.0 and we'll go pre-revenue. The SPAC craze was insane. Thank you, Chamath, for getting these out into the public markets. But also, shame on you, Chamath, for destroying value for a bunch of individual shareholders.
Yeah, I think he sold his soul in a way.
He sold some Virgin. He's managing liquidity. Okay, he's managing.
Well, I think. Listen, he made a lot of money. I don't know how much my reputation costs, but he risked his reputation to make that money. I think everyone has pretty much given up on him in terms of investing in stuff that he sponsors. Because we've seen what happens, but he made a ton of money in the process. So what's your reputation worth? Honestly, if I could make $1 billion to throw away my reputation, I'd like to say I wouldn't do it, but it's very possible.
Yeah. The process though is gut wrenching because he had to just act like he basically had to lie a lot, for a long time.
Yeah. Lying without lying.
There was a lot of,
and in some cases actually lying. I agree. All right. We got lots of comments in here. South Africa, that would be an interesting sort of emerging market. Definitely don't know the area well enough, but sounds like you say you're from there. I'm South African, so I was just curious. We have very big companies here that have gone international. Richemont. How do I know Richemont?
Luxury.
Were they bought by Farfetch?
No, the relationship with Farfetch.
Okay.
Yeah, I remember covering that. Yeah, South Africa. Yeah, I mean, it's just, if you're gonna go with those, I would just focus like something closer by, which for us in the United States is Mexico. So
yeah, market that's easier to understand.
Here's a topic. I guess we've already talked. We talked about buy with Prime a lot. Did you see Shopify? Yeah, that was fun this morning.
I think there's a very good chance Shopify scraps it. They stop allowing merchants to use it.
Well, they're that. Let's give some context. Let's give some context. This morning, they're telling merchants they don't want them to use Amazon's Buy with Prime, which is their Amazon's Buy button that
They
would
still can.
impede on Shop Pay. Yeah. They warning. They're warning them. They said here's what they're claiming though, and this might be one of the. Let me just say what they're claiming. They're saying it removes Shopify's ability to protect against fraudulent orders and could lead to stolen customer data. This is Amazon in online shopping, and they're afraid about fraudulent orders. I mean, what an excuse. Are we kidding here? Like, just tell them it's for competitive reasons, but they can't because then the merchants have a worse experience and they can't use, fulfillment by Amazon.
Thing for me, I think if they scrapped the whole initiative and fulfillment by Amazon was still used by Wix and Squarespace, like, yeah, that'd be a leg up for Wix and Squarespace, but I think Shopify would still be all right.
Oh, they'd still stick around. Yeah, for sure. Like, but they're the most not levered, but they have the most exposure to payments revenue, which I just think makes them at the most risk to a Buy with Prime rollout that's super successful. Although Shop Pay is a great product. However, I bought some things on Shopify websites. The shipping experience is awful compared to Amazon. Maybe my expectations are set high, and there's no way Shopify fixes it. Now, merchants could improve this process by Buy with Prime, right? If they had Buy with Prime on those websites I was on, I would be a much happier customer. So it puts Shopify just between a rock and a hard place.
Yeah. And that whole Buy with Prime thing, I think it had honestly quite the negative impact on Shopify stock. I'm starting to see that Shopify cares way too much what their stock performance is.
Yes, red flag. Now,
Like,
a lot of
I thought it was just like, well, they're the next Amazon, whatever, and I still think it's a fine business, but they seem to be willing to do a lot of things to prop up their stock price to keep it hot. Like, and they seem to care a lot internally from a lot of those messages that were leaked. I don't know if that's really a business that I don't want to own a business that's super worried about the stock price 24/7.
Yes, I agree. And it comes back down to the incentives. So the stock-based compensation really drives that, in my opinion. And that's why I think, if possible, companies should avoid that. However, we invest in companies with heavy stock-based compensation, so it's kind of unavoidable. Now, here's a good question. Thank you, Ross, the South African. We're an international podcast. Everyone should know that.
Going global.
Going global. One of the 4 listeners. Great question today. Here's the question, and I think it'll be fun. We might have to get up a list here, but if you were forced to short a company that had a market cap greater than $50 billion, what would you choose? We had a work competition with this parameter. I need to pull up a list first, but does anything come to mind for you?
I mean, valuations have come down so much that I think it would have to be in a business that I think could be obsolete eventually.
Look, I might say Tesla. It's the widowmaker, but that might be one of your best options at this point, just valuation wise. I got a list here of the top market caps in the world.
Dogecoin, maybe? No,
that doesn't count. What about no, Alibaba's just a trading sardine. You really have no idea what that's gonna do. Maybe semiconductors also valuations have come down a ton. I mean, I'm seeing stuff here like Bristol Myers Squibb. Like, that's just tough. What about an energy company? That's also tough. That's also really tough because you're kind of betting on oil prices.
I'm looking right now.
Okay, here's one. AT&T. I know you got a big dividend to pay on that short, but You have to fulfill that dividend. I don't even know. I don't know how shorting works. I believe you have to fulfill a dividend, but if I'm totally speaking out of my ass, apologies. But AT&T, I think it's pretty bad business.
What about Philip Morris?
No. Come on, no.
I think a long enough time frame, they could be selling to nobody.
No, not in Europe. Come on. They're in Europe. They're never gonna stop smoking in Europe. Well, never say never. That might be a bit harsh, but
Okay, sorry. Does Altria operate in Europe then as well? They do, don't they?
nope. No.
I
Altria
thought they
is
owned some brands that did.
well, maybe, but it would be irrelevant. The Altria owns Philip Morris USA. Philip Morris International has as the company title says international, and that happened what year? 2008, something like that, when they split up the two businesses. Oh, IBM. I think we got our candidate here. IBM. That's easy. IBM.
Above 50?
Yeah, 115 billion. IBM's
Some
easy.
of these
IBM's so
feel like staples.
IBM's so easy. That's actually my choice for sure. We got Ross here saying Nvidia. Yeah.
Yeah, I mean
That's worked out well.
The industry moves so fast that there is maybe the possibility for them to no longer maintain their position in 10 years, and then what do they have? But I mean, some of these are just like, yeah, they could be a short, but they're not gonna like cease to exist.
Agreed. But that doesn't mean it's not a bad short. I mean, IBM, I think, is the easy choice here.
Yeah, that's the only one that seems like a good one. I'm still looking through them, just not there's a lot of international ones that I don't know, never heard of.
Yeah.
What does Micron do?
They're in semiconductors as well. Micron.
Ooh. Activision Blizzard.
Well, no, but maybe. There's a lot of energy companies here as we get into the 50 to $100 billion range. Yeah. See, Ross says really smokers gonna smoke. Yeah, I agree. Smokers are gonna smoke. Philip Morris
International. They're no longer alive.
Well, that's a long enough time frame. Philip Morris International
volumes are down what? 50% over the last 20 years. In the US, they're down a third over the last 10 years. So I think
I know, but this is not Altria. This is Philip Morris International.
Yeah, but Altria is above $50 billion too.
Sure, fair. But as a short seller, I believe you'd have to fill out that 8% divvy. So
yeah, that would suck. And they're going to squeeze cash out of the remaining customers, but
I would disagree on that, but
I could also write the long thesis, I think.
Yeah, we'll see. Who knows?
FedEx.
FedEx is a good one. FedEx is a great one. Amazon. Yeah. I like that.
Anyway.
Uber's 57 billion. We covered them on a not so deep dive. So check that out if anyone's interested. But yeah, it's not I don't think it's probably not a zero.
I don't know if I'd feel.
Yeah.
All the adjustments kind of make me want to short them just as like a spite short. Like just to I hate when companies do that, but I'm not necessarily pessimistic about their future prospects.
Yeah, are they going to create any shareholder value outside of their $57 billion market cap? Maybe. Well, their enterprise value is also a little more complicated than that, but gosh, yeah, that I think there could be a good short. That could be a good short for sure. But I also think I feel like Uber is just gonna. If I had to make a bet, I would say it's not gonna go any like. If we look back 5 years from now, it'll kind of have a market cap of $50 to $60 billion, right? Like,
yeah, I can see that.
Like, it's hard for me to envision this being a tech giant. but it's also hard for me to envisioning it completely going away and being a really good short candidate.
I feel like it already
Um,
has more employees than most tech giants, though.
yeah, what's that employee count?
I think they're at like 30,000, and like Spotify is at like 5,000 for reference. I think somewhere around there. So they've got like,
And all their employees and the drivers are not even counted, which is funny.
yeah, no, it's just a ridiculous amount of employees. That's
Yeah,
actually an insane number.
I know they need to fire a lot of people. If you work at Uber, I'm sorry, but that's
Gross profit per employee must just be abysmal.
yeah, we should have run that chart. Um, I do like running those type of charts. I like running revenue per employee now and comparing
Ah,
it to competitors.
revenue you can't use. You got to use gross profit for Uber.
Well, you do, yeah, I guess they don't have many competitors, which, that could be the bull case, but I like doing, if you do revenue per employee versus, a competitor, I think that's a fine metric to use.
Yeah. All right, we got what, 5 minutes? 3 minutes.
3 to 5
Any
minutes.
closing thoughts? What are you looking at this week upcoming?
I'm looking at my watch list of value stocks and I'm wondering why they are not going down. So they get into buy territory.
What
It's frustrating that the values like stocks that I look at don't want to go down when the market goes down right now.
what about the energy crisis in Europe?
Yeah, something's gonna happen
How are you
there.
positioning your portfolio for
Yeah,
the energy crisis?
I am putting on some hedging trades. Yeah, no, I am doing nothing. You know what? Something's gonna happen in Europe. It sounds pretty awful for some households and business owners in certain areas, which
How are you
I,
positioning your portfolio for the unemployment numbers print?
yeah, hey, yeah. I've been watching that show Industry, and that's basically what they say, but seriously. I'm not honestly doing much. I'm just like specifically, I mean, just gonna, crunch some data for our current portfolio, keep looking at the watch list.
What's the
I mean, I'm
largest
not
holding in your Roth IRA right now?
in my Roth IRA, I own two companies. And it actually I don't know, share Berkshire Hathaway, but that was to get
So
a
you can
pass
say
to
you go
them.
to the meeting.
That was to get a pass to go to the meeting. I own two companies and it is Nelnet and IAC. So pretty boring. Pretty
Mine
boring.
was never mind. I'm not gonna say in case too many people listen to this and it was a small company, but I think my largest now, I want to say it's Nelnet.
There we
But
go.
I feel like we've been talking Nelnet all day, so like, do your own do your own due diligence.
Yep, I would. Yeah, yeah, exactly, exactly.
All right, should I
I
sign
got
off?
yeah. Here's the only thing. Maybe here's something that I was thinking of right before we sign off. If this bear market, it feels a bit kind of like a 2000-ish bear market, evaluation driven bear market. If it is the same sort of magnitude of a bear market, then we'll probably have 3-ish more bear market rallies that hit new lows. And we've already had 2 if you think that this one's going to hit new lows, which who knows. But we've, you know, that's tough.
You didn't strike me as
And
a you didn't strike me as a chartist.
no, I'm just historical, it's not,
Yeah.
that's not technicals. It's just looking at what happens in history. Bear markets have strong bear market rallies that fake people out. Am I going to trade through it? No, but I would just say,
Would you consider Bed Bath and Beyond a bear market rally?
no, I'm thinking more just broad market stuff.
Yeah.
But I think that having that historical context can be helpful because then when something, okay, like you're not super surprised when we have the 4th bear market rally and we hit new lows and the NASDAQ 100 is down 55%, something like that, where yeah, it would still be disappointing for a lot of investors who maybe have more exposure to growth or maybe, long only stuff like that. But you're at least not totally like, geez, I never expected this to happen.
All right. Well, that is going to do it. It's 1:00 Pacific time. We should probably remind our listeners that Brad and I are not financial advisors. Whatever we say or discuss, not formal advice or recommendation. We are general partners at Arch Capital, so we may have, and clients may have, positions discussed in this podcast. Thank you, everyone, for tuning in, and thank you for listening on the podcast. Thank you for the questions in the chat. We will see you guys next week.